Here's one more reason why what the Federal Reserve is doing is a bailout for the banks. As simple as I can in 90 seconds. Interest rates were kept artificially low for over 10 years, giving almost free money to large lending institutions and borrowers. As a result, banks were able to issue mortgages on a 30-year term for 2-3%, which is historically barely over the rate of inflation. So the bank gives a loan for 30 years at 3%, they're making 1 point for 30 years if the inflation stays low. Now, to fight inflation, the Federal Reserve raises the interest rates, which encourages more saving and less borrowing. Meanwhile, all those banks have these 30-year mortgages at a low percentage. When a person goes to withdraw their cash from the bank, what a bank sometimes will have to do if there's a lot of withdrawals is sell those mortgages to other financial institutions. These are mortgage-backed securities. But if the rate of inflation is 6% and you have a 30-year note at 3%, the value of that note is not the full term of the loan 30 years at the 3%. It's worth less now. So let's just use fake numbers. Somebody borrows $100,000 and the amount that they have to return back is $150 over 30 years. But now that $150, the end of that 30-year term, because of the rate of inflation, is not going to be worth what $150 would be worth today. So when you go to sell that note today, you have to sell it for less. The Federal Reserve Bank is giving banks the value of that paper 100 cents on the dollar and buying all of these loans that are underwater on paper. And since they don't have money, they're printing money to do it, which causes inflation. It's a bailout.